Hi, it's Jeffrey Cohen, Chicago Quantum. It's Sunday, March 19th. I'm a registered investment advisor, stock market analyst, market newsletter publisher here in Illinois, registered investment advisor. And we're going to talk a bit today about what we see in the market. We ran our run, our up run and our down run, and we want to share some of the knowledge, some of the content. Some things really stood out, and probably important we let you know. And the funny part today is we're letting you know on Sunday about how the market's going to be on Monday. Normally we do it first thing in the morning, but give you some time to think. So first thing I want to point out, and we made a blog post on our website, but I know a lot of you don't necessarily check the blogs on the website. So the first thing is this is a down run, so this is looking for stocks that will fall. And the variance of the S&P 500 continues to fall. So what that means is the market is starting to slightly calm down. That's helpful if you're trying to invest in stocks and have less risk. So the variance is slightly lower. The expected market return is slightly higher. You can see the return to risk over the next year is 4.27%. So why does that matter? Well, for a while now, it's been under 4%. So why would you risk your hard-earned money, your savings, for 4% or less? Now it's 4.25%. It's at least a little better. You still get the risk-free rate of return of 4.3% that you could earn right now with U.S. Treasuries for 13 weeks. But at least the return is almost double your risk-free rate. And it's okay. It's not great. But what that does to our model is it turns on some of the risk factors. You can see that the QQQ, the Russell 2000, so the NASDAQ 100, Russell 2000, S&P 500 are all down for the year. They've been down for the year for a really long time. And so who knows when this thing's going to go back up, right? But it's just a thought for you that what's happening now. And the other thing that's important is what's the return of the stock market. So if you were to hold 3,400 stocks, 3,407 U.S. listed stocks evenly for a year, our model suggests you're going to make 9.29% in both capital gains and dividends. So you learn, it looks like it's coming in around 7.5%, 7.75% plus dividends. Okay, it's not 10, but it's not bad. So that drives the market risk higher. So that's what I want to share about the market. And then our run actually gives you the stocks that you would buy for Monday morning. And there aren't as many. I'm going to take my pictures offline here, and I want to see if I can describe the best pick. I just don't want to share it because we actually sent our run to some clients today, and clients and potential clients. So I don't want to give away the store. They paid for it. So, but you got stocks in here that are large cap tech stocks. Ones that everyone knows, like top 10. But you've also got some interesting little stocks. And like one of them's Ford Motor Company. That's interesting. One is MasterCard. One is B. Riley. That's a lot. And B. Riley is because of the dividend they paid last year when things were going great. There's other financials. So what I would say is tech, financials, got a uranium company in here. You've got an investment house in here, software, financial services, payables, semiconductor. You got an e-commerce company. You got some interesting, but the fact that there's only 26, and if you want to go down only 2 ticks in Edge, you can get down to 22 stocks held. Now, this model's been picking 50, 60, 80 stocks recently. So it's a lot fewer stocks, larger stock positions. It's time to get a little excited. And so there's been some news. So one of the big pieces of news is that UBS agreed to buy Credit Suisse. Now what's interesting is if you look at the headline, for more than $2 billion, but truthfully how you should be reading that is that UBS agrees to buy Credit Suisse and be held indemnified from Credit Suisse losses of up to, I believe, $10 billion. And the Swiss government has come in with a liquidity promise for Credit Suisse, and I'm assuming when UBS buys it, the UBS owner, something like 100 billion Swiss francs, which is about $100 billion. So that is a tremendous deal for UBS, but UBS, I believe, is going to be spending years unwinding the mess of Credit Suisse. So it's not like SIVB, which just went bankrupt. UBS is throwing a lifeline to Credit Suisse with the help of the government. It's kind of like our Bear Stearns moment from 2009. I want to say January or March 2009. And so it's exciting. They're buying the bank for $2 billion. So, the Saudis that just bought 10% for billions would be getting $200 million. I just want you to think about that for a minute. The amount of money that's being lost by the latest investors of Credit Suisse. So you remember the saying, don't catch a falling knife. Well, yeah. So a couple other things I want to talk about. The other is, why do I say that interest rates have fallen? Well, because they have. The 1-month Treasury is down to 4.15%. So let's take a look over a month. And you'll see that it was stable at between 4.5 and 4.75, and it's dipped below 4, and it's just now above 4. So you're talking about a decline of about 0.75%. That's a big decline. We look at the 13-week Treasury, and you see it's at 4.29%. That's also a pretty dramatic decline in the Treasury bill. And an daily interval over the past month, and you can see how, I'm not going to use a bar, I'm going to make it simple, area. You can see how interest rates were 4.75. I was begging people when interest rates were hitting about 4.8 to put some money in some 13-week Treasuries, get it out of the market, risk off all the way. Well, maybe you did, maybe you didn't, because now your 4.8 just went down to 4.3. And you lost 0.5% interest. It's probably still not a bad investment, but it's just something for you to think about. This is very exciting times. Interest rates falling like a rock is actually very helpful because it increases the expected return on risk of the market. Okay. If we look at the 10-year, same thing. You can see the 10-year has been floating around at around 4%. Not quite 4, like 3.9, 3.95, and it's dropped to 3.4. So you lost 0.6%. That's a big drop in a 10-year, and that's a big drop over 10 days. Monumental drop. So interest rates are down. It's great. The other thing I'm noticing is the volatility index, which is the VIX, the CBOE volatility index. This is the actual implied volatility, or the actual price of risk in this market. And just to be funny, I'm going to show it to you with 3 months with a Bollinger Band, a 1 standard deviation Bollinger Band. That is a tremendously wide Bollinger Band. So I got to do I'm going to do 2 standard deviations because it's too broad. Oh, it's even more. I'm going to go, not 2 standard deviations. We're going to go, I wonder if I can do a 0.5 standard deviation. Yeah, I can. And you can see how the market is dramatically up on the price of insurance and how it's staying high. It's peaking higher over the last couple days. And so the insurance on risk is very high. Risk off is becoming risk on. You get like a perfect storm of just excitement in the market right now. I don't know whether the market's going to open up Monday, but I can promise you it's going to be a very exciting time. And if we were to look just for a moment at how the market did this past week, maybe this will give you a sense of where you should be kind of making your bets, right? So we'll take a look at this. I love this chart, by the way, for FinViz. I probably should make it a little smaller so you can actually see it. This is really hard to see. I'm so sorry. It's so hard to see. I've got to. There we go. Go 125%. Finviz.gov. Love the site. So this is a one-day change. It's extraordinarily red, but it doesn't really tell you much. Let's look at it over the month. Over the month, you see banks are down roughly 20%, 15 to 20%. Energy's down 10 to 20%. Consumer cyclicals are down 10 to 20%. So this has been a dramatically terrible month for stocks in areas that most people will want to spend their money. For business to business, it's not bad. Google, Meta, semiconductors, tech, gold. Gold's way up, although it's not really. Gold's actually quite down. Those stocks are not doing well. So really, over the past month, it's just been a bad market. Disney down 15%. AT&T down 6%. Target down almost 10%. Tesla, Ford, General Motors, just across the board, it's been a terrible month. And so our model says maybe things will turn a little bit. Let's see if there's any questions out there. Nope, I don't see any questions. But go ahead and ask me anything on the chat. Is there something else I want to look at? I mean, energy down means something. So let's look at the futures. Crude is down to 66.50. Natural gas is back to where I kind of expected it to be, under 250. It's 235. So we're back to where we used to be. So get natural gas at 235 means it's probably not that profitable to do a new gas only, drilling. And when you look at oil has been floating between 80 and 70, and it's fallen below that support level of 70. It's at 66.50. So the reason that crude oil would be down to 66.50, there's only two things I can think of, and both are amazing conjecture. So here, if you're ready for the Jeffrey Cohen, Chicago Quantum conjecture on this market, either the war's going to end with Ukraine and Russia's going to be allowed to export again, and it's possible that there are conversations going on where Russia and Ukraine make a peace treaty. If that happens, that explains this, bar none. The second is we're in for a massive recession, and we're going to destroy demand. People are not going to be going on summer vacations. They're not going to be going to work because they're all fired. They're not going to be buying things, so that shipping and transport and warehouses and all the use of oil and gas for transportation will drop. Personally, I'm not sensing, I can't see the recession. I can't. I can see an end to the war in Ukraine. So maybe that's what this bet means. It also could mean that we've been drilling a whole lot of oil wells, which I know is true because one of the stocks I follow looks great. It looks great. It looks like I'm going to buy some, right? A pipeline company. So there's been a lot of wells drilled in the United States, but that doesn't mean that the world oil price should be dropping like this. From 80 to 66 is almost an 18% drop. That's a big drop in oil. And I don't see it. So my guess is we're going to get some good news out of the war in Europe. Or it's a massive recession and like bar the door, but I don't see it. I bet if I were to look at the news, world markets set for relief after UBS rescues Credit Suisse. Now our model was run on Friday. The news was set on Saturday. So risk off is now being reinforced by a Credit Suisse deal, or it's just being reinforced by headlines. And those headlines may be influenced by the people that benefit from a risk-off market. Okay, that's interesting. That could be like a whole conspiracy theory thing, and that's not what we're saying. So Xi visits with Putin. Let's talk for a minute about how this may play out. Xi says to Putin, I got 300,000 troops on your southern border, and I'm your friend. I want to help you. So one way I can help you is that you could get tied down in a war on your western front, and you can just cede the eastern third of your country to China, or I'll just take a piece of it. I'm good with that. Just have fun. By the way, when you piss off the U.S. enough that they declare war on you, I'm going to come in on their side, and I'm going to take land and resources from you, and you're going to beg me to do it. Or you're going to make peace. You're going to make peace. China loves peace, and we're going to buy a whole bunch of your oil. We're going to buy nickel, and we're going to buy steel, and we're going to help your economy, and we're even going to make a ton of money rebuilding Ukraine. Make the peace. Make us all rich. And I'll make sure that your friends get to steal a whole bunch more money, because you kleptomaniacs, that's really what you love to do anyway. And you were a third-rate KGB agent, a second-rate FSB agent. You know you need friends. And your Leningrad cronies aren't going to save you this time. So do me a favor, make some peace. That's how I see it. I'm calling it. I'm calling peace in Ukraine. And that's what's driving down oil. And that's how I'm going to end this video, is to say it's a risk-on Monday. It's an exciting Monday. People are going to make a ton of money making bets on individual stocks. And I bet within a month, by April 15, tax day in the United States, you're going to see peace between Russia and Ukraine. That's all I got for you. This is Jeffrey Cohen, registered investment advisor out of Illinois. We're able to take clients from all over the world. If we happen to get a massive influx of clients from a geography, we'll have to register with that state as well, but that's a problem I'd love to have. If you want to learn more about us, check out the website, www.chicagoquantum.com, and please subscribe to the YouTube channel if you like videos like this and you want to get notified. It makes it easier to find the videos, and you learn a lot. By the way, we just, not that it matters to you, but it might, we just bought a full YouTube setup. New camera, new tripod, new lighting, same microphone, but I realize I probably need to get one of those things which puts the arm like over your face, and so it's not on the table, because every time I tap the table, you hear that through the microphone. So thanks again for watching. You guys take care now. Good luck in the markets on Monday. Oh, I see we do have someone. Any questions out there? I'd love to take one. So, I don't see any questions. And again, we talked about it. Is there something maybe I can share from the run that might help you? You know, maybe this. Maybe this. So, so one of the things that we do is we run our model without ETFs, without exchange traded funds. And the reason that we do that is we want to keep it pure. I'm going to show you something. That's what I'm doing off stage here. And so we just want to show you the good stuff, right? The stocks, the regular stocks. And so what I realize is, for a lot of people, they want to see what the negative beta, the synthetic plays are. They want to see ETFs. And so I'm going to show you what the ETFs are. And I'm going to tell you a little story here, which is our model has a different thing. I'm looking at the questions. I don't see any questions, so I'll go with this one. So negative beta stocks, there are a few of them. And so there's more than there used to be because the risk in the market has gone down. But one of the things I want to show you is that there are some very, very negative beta stock plays that you can bring in, and they're synthetic. They're not stocks. They're ETFs, they're exchange traded funds. They're something somebody made up to give you a chance to make an investment. And so there's 5 of them. There's UUP, which is the US dollar. The US dollar is running 21% negative beta. So it's 21% the opposite direction. You've got VIX short-term futures 2 times, VIX regular short-term futures, and then you've got the bear shares. And the bear shares are running negative, which makes sense because the market goes up, the bear shares go down. So the math works. That's what I hope I've convinced you of by having these synthetic stocks in there. But then you also see like Veru and U-Haul and Summit Therapeutics, which is a pretty serious company, are negative beta, and Chesapeake Utilities and a bunch of names that I don't know, like Sidara and Syngin and First Wave Biopharma and Green Wave Tech. I don't know those companies. Molecule, Veru, but I know U-Haul, and U-Haul's running negative beta. So some people will want to bet with these as a hedge against the market falling because they think, oh, market falls, negative beta, they go up. But just know that these are anomalies, and there's more anomalies. And more anomalies usually means that there's more risk on in the market. And so just want to share that with you, negative beta. Hey, thanks for watching. You guys take care. Good luck in the markets on Monday. Bye-bye.